Okay, well, the next 30 minutes on ET Now and again on a digital channel, I want to just bring representatives of the entire mutual fund industry to really understand that how should one really read into this Frankin crisis. I know doubts have been raised that, okay, this is going to be a snowball effect, a contagion is going to be made. Is our money safe? Is this death of debt? Now, in a financial market, how should you understand risk and volatility, and is this problem more like a specific problem to a fund house, or this is beginning of what could be called as a near-term and medium-term pain for a lot of mutual funds which have exposure to AA grade of debt? Let's take the conversation forward. We've got Nilesh Shah of Kotak AMC, Milan Varve, SBI, HDFC Mutual Fund, Ashwini Bhatia from SBI, and A. Bala from Birla AMC. You know, it's fantastic to have all of you, and I'm glad that the entire industry has unified in a sense so that we can get the right message out. So I'm going to just ask some very basic questions, starting with you, Nilesh Bhai. When you read a news like this, and if you are a unit holder, you will get anxiety pangs. And why not? Because debt was supposed to be safe. Why do you think this has happened? And do you think this is more like a AMC specific problem, and this is no indication of the fragility of the debt market and how AMCs will deal with this COVID crisis? Nilesh Shah?
Thank you, Nikunj Bhai, for giving opportunity to Association of Mutual Funds in India to reassure investors. Clearly, if you look at majority of mutual funds today, they have no borrowing whatsoever. This is despite the fact that we are allowed to borrow up to 20% of our debt, our AUM, to meet redemption and dividend repayment obligations. The fact that there is no borrowing at majority of mutual funds shows that there is ample liquidity in our portfolio. Credit quality of our portfolio is fine. And even in this challenging time, we are able to run our business on a normal basis with repayments running into thousands of crore to our investors on a daily basis. Second, my recommendation will be to look at every mutual fund's portfolio and see for yourself what kind of credit quality we have. Almost 90% and more of our AUM is in non-credit risk fund, where bulk of the portfolio is of superior asset quality, as confirmed by independent rating agencies. They are liquid in today's market, and they are geared for appropriate liquidity through secondary market as well as self-liquidation to ensure that day-to-day operations are run uninterruptedly. Looking at our portfolio's credit quality, liquidity profile, we are confident that our business will run uninterruptedly despite isolated event at one of the fund house.
The Reserve Bank or the government.
Okay. Mr. Barve, I'm sure it would be unfair for me, Mr. Barve, let me rephrase this one, to request you to comment on some other AMC. But I can request you to comment on the current credit quality which HDFC AMC is maintaining. I'm sure you must have also done a complete magnifying analysis of the credit and the liquidity of the debt schemes and the debt instruments you have. Would you like to walk us through that? Would you like to tell mutual fund investors and unit holders that barring the market risk, their core investment is safe, and if yes, why and how? Mr. Barve.
Yes, certainly. Thanks, Nikun. So first, let me start with the credit risk fund, because that seems to be the focus of the attention and the discussion, and maybe rightly so at the moment. When you even just hear the word credit risk fund, it seems to just signify that entire portfolio in that fund is all high yield and very low credit quality. That is far from the truth. The reality is that most of the credit funds that the industry players run, including us, of course, have between 20 to 30% in AAA and cash, and the rest, another 50% or more, in AA assets. So by no means, when you even mention the word credit fund, does it mean that this is like, because we seem to almost talk of the credit fund almost like it is a junk fund, bond fund or something. So I think I do agree, I do believe that, as Nilesh said, this is a one-off incident in the industry. It is not reflective of the industry, what the industry has in its portfolio, both in terms of the credit quality as well as the liquidity that is there in the portfolio. If you look at our credit fund, for example, between cash and AAA, we have about 20% of the portfolio is AAA or cash. And we have another about 30%, which is in AA and AA plus, which is almost 55 to 60% is in AA and AA plus. So I think the quality in the portfolio is extremely strong, extremely robust. There isn't any reason to feel worried about the credit quality, or even in the current market, there is adequate liquidity. Across other funds, which is non-credit risk funds, it is absolutely a non-issue. There are no issues about concerns about investors. People are buying into either liquid fund, overnight fund, or short duration fund. Yes, there is a mark-to-market risk that if the interest rates go up, which is very unlikely. So I think I do see this as a one-off event which the industry has to deal with. We need to reassure our investors that every fund house and the funds that they manage have very different credit characteristics in their fund. It's important that you look closely into what these have and to then make an assessment. There is no need to panic. And therefore, I think that as far as we are concerned, we are sitting on very high quality papers across most of our funds. And even in the credit risk fund so-called, we are having significant amount of AAA portfolio and even AA and AA portfolios. So I do think that I can understand, as you asked Nilesh earlier, that people will see this in the headline and wonder whether this is something that they should worry about their entire debt portfolio in mutual funds. I think it is. We are all here to say that that is not true. You need to feel anxious about exposures in other debt funds. Look at the portfolios. Do go to your advisors and take their help in assessing whether there is a real credit issue or a liquidity issue in funds, and then take a decision that is appropriate. I mean, there is no need to panic. I do feel that the Central Reserve Bank has done, and SEBI in its own way has done a number of things which will reinforce confidence amongst investors. Maybe more steps will be required, and I'm sure over time they'll get done. So I think we should be able to tide over this. I don't see this as something that is should be worried about as investors in mutual funds in general and credit risk funds in specific.
Okay, Bala, good afternoon to you. Now I'm going to bunch my next question into two, and I'm purely trying to address a lay investor here, someone who's invested in debt because on advice of his distributor, or has purely decided to maintain the asset allocation. Now 2019 also, there were unfortunate headlines which came for the debt industry. Now on top of that is this headline. So my question to you, Bala, is that for a unit holder of Birla, what is the way forward? Could you also briefly tell us about the quality of the paper which you hold? How liquid is that? And can you really handle if there are redemptions?
Yeah, I think interesting, Nikunj. I think the whole credit crisis, if you look back, it started in September 2018, and then that crisis traveled the whole of 2018 and 2019, and the whole NBFC's crisis came. Now, of course, the issue that is being discussed around the Franklin Templeton stopping the redemptions and so on and so forth. So, and in this whole process, of course, all of us have been running credit funds. Of course, one does take credit risk in the funds, which is supposed to invest in instruments that are less than AA. And having seen the whole thing evolving way back in 2018, and we as a fund house have gone extremely cautious in terms of adding incremental risk to the portfolios. As others mentioned, almost as Nilesh also mentioned, in the proportion of the total assets under management, only about 7-8% come from the credit-related funds. The rest of the 92% of the funds come from the those which invest in high-quality names. Then second is, we also, of course, measure the success of your portfolio quality not just only on the basis of AAA and AA+, how much actually are liquidatable assets, how much of the companies in which you are investing can go for refinancing from the market, can go and tap the market for repaying your debt, and that also gives a lot of comfort. And in fact, in the month of March, when there are a lot of redemption pressures, I must also mention that we did not tap even the 20% limit that's available for borrowing. And we didn't even tap that because there was absolutely no need to borrow. And given the fact that the portfolios were liquid, we could actually liquidate the assets. But we could also, on the basis of our own internal research, and we could also prepare ourselves for any potential outflow that could happen in the month of March. This is the way I think we manage it the last so many number of years in fixed income schemes. Of course, accidents, some of these kind of come and go. But these things, I think, should not be seen as something creating a permanent damage for the fixed income schemes. So I myself manage money in the fixed income scheme, handled 2008 crisis in the past. And we also gone through a similar credit crisis way back in 1994 when Nilesh was there in the market at that point of time. We went through that period when we saw credit defaults coming from few companies. And this actually does not last for too long. It's temporary. It impacts your sentiment. It impacts the portfolio. I think fixed income something, I think if you stay invested 90-95% of funds, remain invested in good quality names, I think it'll come back. So that's the way I think we are managing it. And believe me that while the scenario has been a little tough, but I think the way you take proactive action in constructing the portfolio has been helping our fund, especially managing on this kind of occasions, managing the portfolio volatility as well as on expectation of returns. Both we are able to do that quite nicely, given the fact that we are well prepared to meet this kind of things at a regular interval.
Willing to lend to the tail.
Okay. Nimesh, we've seen debt market crisis in the past. That's the nature of the financial markets. But when you see a headline like this, the obvious news comes, which obvious fear. And again, I'm being repetitive with this one, but I'm trying to, perhaps douse the fire here, address all aspects of human psychology, both for corporate and for retail investors. So Nimesh, my question is, people are saying, is this repeat of 2008? And we know what happened to the debt market in 2008. Why do you think this will not snowball into a bigger problem or a liquidity crisis? We've seen what's happened to the LTRO yesterday. In a sense, banks are still reluctant to give money to smaller NBFCs. So how will things improve, Nimesh?
Just step back and say that when you were asking why there is if yesterday, you gave me yesterday's example just now, so we start from there. How does that affect the mutual fund industry per se? Because mutual fund industry per se won't be on those kind of NBFCs at all, right? Most of the mutual funds are only in the big AMCs. When I say for myself, most of the AMCs in the relatively bigger and give even money today, which the banks are half years since the NBFC crisis, the so-called NBFC crisis came along. Mutual funds, more or less, except some exceptions, have not had any defaults in those particular AMCs. I'm talking about coming to what is the nature of this industry. When I'm looking at, I'll give you a micro example. 28% of our investments are in, right? We are talking only about 2% of them. When I look at the AMC overall, even if you look at a credit risk fund, which is only at the industry level, credit risk fund is only 50,000 crores amongst the 10 lakh crores that the mutual fund industry would be managing, right? In that 50,000 crores, or in a particular in our AMC, out of the 75% is AA minus and above, right? So when you say that how will it be liquid or how money will be paid or what help you need, we don't need anything. We just need the investor to be confident that he's getting a good deal today because the spreads are very high. This is when there is fear is maximum, that is the best time to invest in that particular asset class. So if you invest in a credit risk fund today, forget anything else, invest in credit risk fund today because good spreads are available. If you are taking a credit risk, you are getting compensation for that. And what has happened with one of the AMCs, I compare it with somebody driving at full speed on the highway. There is one particular guy who's driving at a very high speed, and there are others who are driving at reasonable speeds. So somebody is going at 120, 130, and somebody is going at 80. That person, if he has an accident, if a guy goes very fast and he gets an accident, right, that does not mean the others stop driving, right? It will continue. The one who has, in our industry, who's driving fast, who gives the maximum yield, right? There is an obsession with YTM. When I talked to you last time also, I had mentioned that to your investors, that highest YTM means highest risk. In India, there is no difference between the way we are handling money. I know what Nilesh Shah is doing, what Milind Barve is doing, what each of the companies is doing. All of us know where I invest. They also know. So the only way of YTM, there is a new word that is very fashionable amongst investors and distributors, is YTM. Last 3 years, we have been hearing that word. So I've been saying higher the yield, higher the risk, right? And the incremental risk is always more than the incremental return. So somebody is taking highest risk. You cannot compare with somebody who's not taking that much risk. And we have got liquidity. All of us have already built liquidity, right? At least we have built liquidity. And if redemptions come in, we should be able to handle those redemptions. It should not be an issue, right? Because as I said, 75% of the portfolio being AA minus and above, that can be sold in the market today. There is liquidity in the market, right? There is 7 lakh crores which is put in reverse repo. There is liquidity in the market. So can it be better? It can always be better. If there are not desperate sellers in the market, it will be in a much better shape. That's where I would like to, that their liabilities, if they come.
Okay. Ashwini Bhatia, I'm coming right back to you, but I have an immediate follow-up question for Nilesh Shah. Nilesh, a very basic question is that I'm sure your distributors would ask you the following. Nimesh Bhai, bond market is a reflection of economy. We know the economy is in problem. Cash flow is an issue. NPAs will go large and liquidity is a crunch. And for small companies, they are not able to borrow from bank. So why do you remain confident that there is going to be no crisis? Would you like to respond to this very simple question, Nilesh?
Definitely. See, undoubtedly, we are going through unprecedented time. This is like betting on the 5th day pitch, which is bowler friendly and has torn down because of the 4 days play. But as Nimesh mentioned, a good batsman will still be able to score run. A poor batsman will be finding it very, very difficult to hold on to his wickets. Let me tell you some of the steps taken by our regulators, RBI and SEBI, to normalize the market operations. There has been pumping of liquidity through CRR cuts, through LTROs, and through open market operations. As Nimesh mentioned, now the liquidity in banking system is 7 lakh crore. On 27th March, RBI cut repo rate by 75 basis point. Thereafter, they cut reverse repo rate by another 25 basis point. This rate cut has also eased market yields, and today 10-year yield is hovering at 6%. Third, RBI introduced long-term repo operations, which encourage banks to borrow at fixed rate of borrowing, at fixed rate of interest, and lend money to corporates and NBFCs. There has been substantial infusion of liquidity to various creditworthy corporates and NBFCs in last 1 month. The RBI also conducted Operation Twist by buying long-dated government securities and selling short-dated treasury bills. This they did to influence market yields, to keep yield curve under control. And this combination of steps has ensured that liquidity reaches out to the borrowers where we are operating. Have they completed their job? Answer is no. As situation evolves, I'm sure they will be taking corrective action. We have also seen corporates taking corrective action. One very large corporate did a big foreign direct investment deal, even in this challenging circumstances, and brought more than $5 billion into their balance sheet. So as situation evolves, I'm sure regulators will take corrective action. Companies will take corrective action. And as repeatedly mentioned by all my senior colleagues, today, most of the mutual funds have reasonably liquid portfolio, have reasonably solid credit quality, and have zero borrowings as of today to meet our redemption or dividend payment obligations. We believe with the support of RBI, SEBI, we should be able to run our operations on a normal basis. And the isolated event which has happened in one of the mutual fund will have no bearing on the other mutual funds.
Okay. Mr. Bhatia, good afternoon to you. I'm sure you must be getting difficult calls, some WhatsApp messages, talking to your product and your distributor heads. Nilesh Shah mentioned that you should buy when there is panic. So I'm going to look at the bright side. A damage to a scheme has happened. That cannot be undone. We have to learn to accept that these are extraordinary times, and in extraordinary times, few challenges will happen. But my question to you is that why do you think this is a good time to buy and invest into debt?
So first of all, let me tell you, to your opening remarks. Number one, the money is safe. Second, is it the death of debt? Certainly not. The whole economy runs on debt. These are kind of difficult times, and between yesterday and today, very frankly, nothing has changed. We just had one incident where a particular mutual fund made some announcements relating to its schemes. To your question again, would you be investing in debt at the moment? Certainly, why not? Again, if you are looking at the medium term, I don't think the pain is going to last that long. We've seen cycles in 2008. We have seen that before also. We have seen the dollar breaking the buck in 2008 at the same time. Quality will certainly become better as you go forward. And again, something that others have also mentioned, how much is the proportion of credit risk that you have on your books? I mean, in our case, our credit risk fund would barely be about 2 or 3% of our overall portfolio. So, all our investors do invest wisely. It is also led by institutions. Institutions see the opportunity, and this is, the right time to be there. Of course, now it's a matter of choice, whether you want to be in credit or non-credit or low duration, high duration. That is entirely to the, to the choice of the investor.
Okay. Mr. Barve, when IMF says that this is the biggest crisis, the biggest economic crisis in the last 100 years, and when you see a headline which says that job losses have happened and this is even worse than 2008. So the first question which again comes to everyone's mind is that 2008 was dangerous. It was a disaster for equity and for debt funds, and for those who pulled out money at the beginning of the crisis and pulled it under the mattress, they were happy and satisfied. So my question to you is that if IMF is saying that things are so bad, why should debt investors not be worried, Mr. Barve?
No, I think we have to accept the fact this is not, in a way, the financial markets are seeing the secondary or collateral something which is more a health issue. Clearly, as the RBI governor said, the real unfolding of events will happen once we have clarity on the intensity and the duration of the COVID-19 problem. I do not see anything that is structurally getting weakened in this situation. There would be short-term issues where, because of moratoriums being granted to borrowers for them to pay to their lenders and so on. But I do not see this as creating definitely the challenge on growth. And this year's the growth forecast for India has been pegged as low as between 1 and 2%. So this is not trying to say that this is just one more year. It is an unusual year. We are in unusual times, and we are dealing with unprecedented times. But having said that, you have to make distinctions between what is the likely impact on different segments of the market. And the answer to that question lies in the fact in whether what is the quality of the portfolio you hold. For example, if you are a debt-free company, the impact on you would be very minimal. If you have moderate levels of debt, the impact on you will be very moderate. Similarly, when you look at mutual funds and the portfolios that we run in the mutual fund industry, the impact, for example, the impact on equity funds has been very sharp. I mean, in the month of March, the equity, most of the indices lost between 25 to 30%. And there was no running away from the fact that equity portfolios did bear the brunt of that fall. But having said that, in the debt market is a different, completely set of circumstances. Debt, you have to look more granularly at in more granular fashion. Look at what is in the portfolio. Look at what is the quality of the portfolio, and you cannot ignore the fact that the central bankers and regulator is keeping a very close watch and picking up the number of steps every few weeks, so to say, to ease the tension. So I'm not trying to say that growth is going to go back to 5 and 6% as if nothing happened. That's not at all what I'm saying. But impact on certain specific parts of the market like mutual funds or debt funds will be minimal and will be dependent upon the quality of the portfolio, the liquidity of the portfolios. The fact that we still have to deal with the macro problem about lower growth and having to see what is how long this problem, which is more a health problem, how long does it take to really find a solution to it? When do number of cases start plateauing and tapering down? That's an open-ended question. And I think nobody has a clear answer to that. But having said that, in the circumstances that we find ourselves, the quality of the portfolio, the liquidity of the portfolio, that is going to decide which part of the market is going to see the pain. It is not, pain is going to be felt by all the market segments equally. So I think you're in debt funds, yes, there will be mark-to-market issues, but I think credit issues, by and large, as the industry mentioned, see the credit, as I think Nimesh mentioned, the total quantum of credit risk fund is barely 4-5% of the industry, of the debt funds itself. And when I say credit funds, sometimes we talk of credit funds as if it's junk bond fund. It's not true. You're holding AA paper of more than 70% in the portfolio. Some of us, as I mentioned earlier, have 20 to 30% in AAA and cash. So I think the quality of the portfolio is going to decide what happens to that particular fund, while we still need to deal with the macro challenge of a lower growth and a reasonable lack of clarity in the trajectory of recovery as we go forward.
Okay. I'm shamelessly extending my time with you on a day when you gentlemen have other operational issues to handle. So really appreciate that you've come together, and I'm glad we're having this conversation. So Nilesh bhai, just one last question. I think Nimish on the panel alluded to the fact that, if there are car accidents does not mean you stop driving car. In financial terminology, if problem happened with PMC Bank, that does not mean that every depositor has lost money. It's unfortunate what's happened to PMC Bank, very unfortunate. But again, it's unfortunate what's happening to the investors of Franklin Templeton in those schemes. But that does not mean one should imagine that everything in the debt instrument is back. Is my analogy correct, Nimish bhai?
Absolutely, Nikunj bhai. You have hit the nail. Each mutual fund have a different credit profile, different liquidity profile, and let the decision be taken not on what happened with one mutual fund, but what an individual mutual fund's credit profile and liquidity profile is telling you. Most people will be able to reassure themselves once they look at our portfolios, once they look at our liquidity profile, and once they look at the corrective action taken by our regulator to keep our markets normal.
All right, gentlemen, appreciate your time once again. Thank you for joining us. We've taken half an hour of your time and it's been a big day. Stay safe, and let's hope that these tough times should also pass. And while I'm using the word safe, I may also want to point out that the panel here of the entire mutual fund industry here, between them they have more than